Everybody ready? Okay, let's begin. So, good morning, ladies and gentlemen. Thank you for taking the time out of your busy schedules to show up for this webinar today. I'm sure all of you have heard this before, but we are in truly extraordinary times, and I hope that everyone's families are well. My name is Victor, and I will be your co-host for today's webinar. Our speakers today include Mr. Dylan Poe from IFAST Financial, who specializes in corporate and individual investment management. Dylan, could you wave to the audience to make sure they know who you are? Dylan?
Hi.
Yep, thank you. And Mr. randyang, who is an expert in corporate solutions and business risk and has over a decade's worth of experience in the finance industry. Randy?
Yeah, hi everybody.
Yep, thank you. So we still have a few people who have not joined the call. While waiting, I will briefly go over the schedule for today's webinar again. We will have a speech by Dylan on the market outlook, focusing on Q1 results and what to expect in Q2 to Q4, as well as what potential investment opportunities you might want to look out for. This will be followed by a quick question and answer session. And finally, Randy will be doing a presentation on PIAS and investment strategy. Many of you might have different reasons for attending this webinar. Some might be worried about the economic outlook. Maybe you're thinking what sectors will be hit the hardest within the next year, or you are wondering how to take advantage of this very strange situation that we are in. So we hope that this webinar on the asymmetric impact of COVID-19 will help answer some of any burning questions that you may have. All right. Since we are running a bit behind schedule, I don't think we will be waiting for other people to join. So first up, we have Dylan and his presentation on the market outlook. Dylan, please begin.
All right, hi, and thanks everyone for joining us this afternoon on a Monday. So we are T-minus 2 weeks away from the end of our so-called lockdown. And for today's session, I'll be bringing you through kind of a market update situation on what has been happening through the first quarter, and an outlook perspective of what we can expect for the rest of the second quarter and going onwards or for the rest of the year as well. All right, so on to the next slide. Yep, so we're going to start with the market review first. So on this very first slide, all right, I'm just going to give you a factual update on what has actually happened in the first quarter of 2020. So I think we are all no strangers to what has actually really happened since the start of the year. No doubt, courtesy of the virus and lockdowns, we have actually experienced a significant drawdown in the month of March, in the somewhere in the mid of March, all through to somewhere in April, right? So it was a very interesting time because we actually also saw that it was a very intense session where, it only took 16 trading sessions for the S&P 500 to dip into bear market territory. When you add that on to not just Chinese markets, but markets all around the world and across asset classes as well, where not every asset class, not a single asset class. Now, I would like to remind the participants to mute their speakers so that we can continue. Now, so going forward, this is what we have actually seen in the first quarter on a factual basis. And yeah, to put it in perspective, this is the worst that we've seen since the 2008 and 9 financial crisis. All right, on to the next slide. All right, I think I think there's one slide before this. All right, Randy, why don't I share my slides myself?
All right.
Okay, sorry everyone, just give us a moment.
All right, just a reminder while Dylan is preparing the slides for sharing. Just be reminded to do a mute on your speaker as you are getting a bit of feedback from the background voice. All right, thank you.
All right, so as I was saying, going on from this slide, so this is the factual, situation. And then over here, I would say this is just to give you further context on how the virus has actually developed to date, right? So if you take a look at the left-hand side, the top chart on the left-hand side, you will actually see this pandemic development phase curve, right? So it kind of gives you an idea of where global countries and markets are in terms of their developments with respect to their virus containment issues. So as you can see on the late stage part of the curve, that's where China is lying, because as you all know, that's where the virus first started out as well, in Wuhan. All right, so when it first started out in Wuhan, they were the first to also impose, the strict lockdowns that we saw for 2 months straight back in late January all the way to March. And then slowly following behind China are all the other countries like US and some of the European states like Italy and Spain and Germany, who were all actually making the headlines when we were still celebrating Chinese New Year back in late January, right? So when we were still out and about, these countries were already experiencing high numbers of cases and surges in the number of cases within their perimetries. And because of those, they also subsequently went into lockdown situations after that. So for Singapore's case, I would say we're somewhere in between the early control towards the improving stage. No doubt we have 2 more weeks left in our own circuit breaker measures, and we also hope that there will be no further extensions on that. But definitely we keep faithful and hopeful of how things will pan out from there. So you can think of this curve as a train ride, right? As an indication of whoever gets onto the train will also likely, get out of the train first as well. There definitely is a lot of questions right now on whether there's a potential second wave of infections within this space, but definitely we can talk about that later and how that can potentially impact our markets as well. All right, so this is to give you some a context of the how the virus is actually developed across nations. And over here, in terms of economic impacts, we actually do see, because of all the lockdowns, GDP revisions have been brought downwards across all over the world, from not just US, but also in the Asia, ex-Japan and China regions. So it is a very unique situation this time because both demand and the supply indicators were being brought down because of the lockdowns. So for the lockdowns, you can't really, when you're in a lockdown situation, you can't go out to consume things. Therefore, that dampens your demand. But at the same time, your lockdowns also prevent you from going to work or your factories. And therefore, you also take a notch down on your supply side indicators. So when you combine both the demand and the supply side story, you actually do see quite a significant drawdown to your GDP revisions for the rest of this year. So if you look at the second chart at the bottom left-hand side there, we are actually definitely already in recessionary territory for at least the second quarter of this year, and we'll definitely start to see probably some bottoming outs from the third quarter onwards when economies all the world start to slowly reopen themselves around the world. Okay, so that sets the broader context of what has actually happened so far on a factual basis. Now let's take a look at the future, if I would like to, for lack of a better word, the market outlook on what can potentially happen. All right, so if you look at a 1-year basis, I've just drawn out the chart performances of the Shanghai Shenzhen Composite Index in black and the S&P 500 index in orange. So I would hope this gives you some visual representation of how both the US and Chinese markets have performed on a 1-year basis. So definitely you see in late January, that's when the Chinese markets first took a hit. When the viruses first started to break out since then. And then slowly after that, that was when US and all around the world, that was when we experienced the 30% plunge from the early March highs to late March lows, right? And then we have since recovered for a little bit since then because of the government stimuluses and central bank cutting rates and so on and so forth. All right, so that's on a 1-year basis. But you will notice that on a year-to-date basis, you see that because of the way the virus has developed at different speeds around the world in terms of who got in and who's going out first, you'll see that China, as denoted by the black line, its stock market is denoted by the black line, is sort of recovering faster than the rest of the world, because that's when when everyone else is still in their lockdown situations, China is already slowly but surely starting to re-emerge from its lockdown situations. So definitely we start to see some broad recoveries in that space. And this is why we think that China will continue to lead the recovery, going forward for the global economy for the rest of this year. So you see that, on a broader basis, on the first chart on the left-hand side, the top chart, you see that most provinces in China are already near their fully resumed operation status, right? You see for most of the provinces over there, so they are already close to 95 to 100%, fully resumed working operation status. I would say the only parts of the economy that may or may not have reopened yet would be, the higher risk segments like your cinemas and your nightclubs and your bars, right? Because those are the places that would expose the people to a lot more interaction, human contact than other spaces. So I think barring those few sectors, I would say the rest of the broader Chinese economy would have close to recovered at this point. All right, and then you move on to the second chart on the left-hand side, bottom left-hand side, you see that this daily average coal consumption chart here, all right? So there's an indication of the amount of energy that the Chinese economy is consuming at this point. So you see that that line has been slowly increasing since the end of February, right? And it kind of shows that, the factories are starting to get busy again. People are returning to the factories to manufacture things. And therefore, you start to see an increase in the amount of coal consumption in the Chinese economy from there. And then you also see, on the right-hand side, the last chart on the right-hand side, this thing called the congestion delay index, which is more of an indicator of the kind of rush hour traffic that, the Chinese economy is experiencing. So you see in most of the major provinces like, Shanghai, Beijing, Guangzhou, and Shenzhen, right? You see that since late February, it has been slowly picking up since then. It kind of shows that, the roads are getting busier, and it shows that people are at least getting out of their houses, right? Even if they're not going to their workplaces, they are also, going out, and when they go out, they need to consume. And when they consume, that actually continues to feed into the GDP equation. And therefore, that leads on to economic recovery and economic growth going forward as well. So, we are very confident that, in the longer term, this trend will continue to pick up as things start to recover and reopen, and the Chinese consumer will return, and therefore, it will lead to the national recovery going forward. All right, so what our team has done here in this space is to actually kind of do some, kind of make some simulations on what the situation might actually pan out for the rest of the year. So we've actually, based on our own macro assumptions, it's not done by me, this is done by my research team. So, I'm here to sell you the idea that, or present to you the idea that in the sense, China is not going to go into the doldrums forever, right? Definitely we've seen a kind of a hit in the first quarter, but definitely our view is that it will start to recover. And our neutral base case is that denoted in yellow. And of course, we've also, accounted for an optimistic case scenario if let's say there is no, drastic second wave of infections, or the economy reopens faster than we expect, Chinese consumers return faster than we expect, then, therefore we could have a potentially optimistic case scenario where the GDP, growth rate revisions could be even higher than expected. Right, but we also have to be very realistic in the sense that if things don't go as expected, don't go as well as we want to, second, third wave, fourth wave, fifth waves of infections come in, vaccines fail, then, maybe there is a pessimistic case scenario, which is, a little bit more dampened from the neutral solution over here. All right, so this chart shown here shows you the kind of base case allocations that our team has actually, come up with. There is no right or wrong kind of predicted numbers, because essentially no one can really put a finger on what's going to happen in the future. But, you can use these figures as sort of a guideline, on how things can actually pan out in the rest of the year for 2020. So, on a base case basis, we actually look at a rough 3.8% GDP growth for China's economy as a whole for this year. But, definitely these assumptions and these figures can change from time to time as the situation improves or deteriorates accordingly. Right. So of course, in the optimistic and pessimistic case scenarios, it can range anywhere from 2% all the way to about 5.96%. And these ranges are actually in line with what most of the other analysts on the block are actually saying. They are actually projecting around a 2% to 6% annual GDP growth rate for China in the year of 2020, right? So no one really knows what the figure is. In fact, the Chinese government has also removed, their numerical target for GDP growth rate targets this year. So in a sense, this is also largely due to the fact that it's really very difficult to quantify, in that sense, the real certainty of how this whole virus pandemic is going to turn out. But definitely you can always use these figures as some sort of a guideline to actually where you can position yourselves in your portfolios. All right. So this is a summary slide to kind of show you why we are very confident that the Chinese consumer will return again. So backtracking to 17 years ago when we saw the SARS crisis break out in 2003, definitely because of lockdown measures, you can't really go out of your house, and that's why retail sales of consumer goods dipped. All right, you have seen since then in 2003, as I have already outlined in the red circle over there. But what has changed since then is that right now you don't even have to go out to consume, because you are promulgated with all your e-commerce companies online where you can buy things online. To give you an example, I was even doing my own shopping on Sephora a couple of weeks back, and before I could even press my orders onto the carts, everything was already sold out. Right, so this is a really good example of how things have actually changed since then, right? With the influx of tech companies and your e-commerce space companies, all these are providing new avenues for the consumer to continue consuming in that sense. So, definitely things are a little bit different from then, but ultimately we'll have to see and monitor how the data is going to pan out in the next quarter or so. All right, so this is our own China ACSI 300 index projection. It was done as of end of April, somewhere around there. So it is a juxtaposition of the price index versus its earnings as shown by the red line. So definitely there is a positive correlation, but our team has actually priced in about 48% upside from now to the end of 2021, just justified by the fair price to earnings ratio, right? So the reason why we are also largely bullish on Asia ex-Japan equities or China A-share equities is because of their largely undervalued status compared to their Western counterparts like the US stocks. All right, so this is our own index projection. Once again, speak with your own advisors on how you can position yourselves to get exposed to the China A-share space or other Chinese equities, but you can use this as your own guideline. All right, so in terms of an investor, from an investor's point of view, what does it mean for your own portfolio? What should you do? All right, from an asset allocation perspective, definitely right now we also still see that equities are trading at a more favorable level than their fixed income counterparts. All right, this is largely because of the way the numbers are actually showing, because due to the large drawdowns experienced in March, and coupled with the interest rates being cut to near zero, we're actually seeing the equity risk premiums at near historical highs since the 2008 financial crisis. So if you look at the left-hand side top chart here, you see this indicator called the excess yield of global equities over global fixed income, right? This is basically a simple indicator that analysts and investors use to kind of judge how favorably the equities are, valued against their fixed income counterparts. So, in simple terms, how to interpret this is the larger the number, the cheaper, or rather the more attractively valued, equities are compared to fixed income. So as you can see over here, that dark green line is actually trading close to 2 standard deviations away from its long-term average. And that's why we think, it's a kind of a good time based on what the data is telling us to actually get into the equity markets per se. All right, but that doesn't mean that you also have to neglect your fixed income investments altogether, because even in the fixed income department, we are also seeing some hidden gems. All right, and in particular, we are looking at the Asian high yield bond space. All right, the Asian high yield bond space consists of all your, companies like your Chinese real estate developers, companies like that who are, whose bonds are trading at yields of around 5 to 7 to 8%, right? So you see that in the course of just 3 months, the dark blue line actually shot up, right? This dark blue line is actually indicative of the Asian high yield credit spreads. The credit spreads are, the kind of yields that these bonds are going to pay to you. So, intrinsically with a higher yield, the kind of credit risk you're taking is a little bit higher as well. But if you look at the red dotted lines that we've drawn out over here, we've actually drawn out the historical average default rate, which stands at about 2.3%, as shown by the first bottom line there. right? What our team has done is we actually juxtapose a 2 times, 3 times, default situation across the entire credit space through the course of history. And we see that what the market is pricing in right now, it's way off what a fair situation of a default is, because the way that the market is trading right now is trying to say that, we're going to see a 5 times, a 6 times default rate across all your Asian high yield bond issuers. Right. So in that sense, we don't think all these companies will just default overnight, because the Chinese central bank has also taken some measures to help companies to stay afloat, and we do still see some liquidity and monies flowing in the system, right? And then since the end of March, we actually have seen the spread start to tighten a little bit as well. So this trend is likely to continue, and that's what our team is trying to say, is that going forward, it will start to, as things start to improve, the spreads will start to compress even further, and that's where you can potentially gain some capital appreciation from your high yield investments as well. So you can get exposed to this space via the direct bonds, or you can actually invest in certain high yield, Asian high yield funds, or ETFs for that matter. So once again, speak with your own advisors on how you can, get your hands on some of the instruments available, but definitely keep your eyes feasted on this space as well. All right, so this is just to wrap up. This is my last slide here, all right, on what the governments all around the world has already been doing. So, compared to the 2008 financial crisis, no one is in fact actually hesitating to help out, because this is in a way no one's fault. It's a health crisis, not so much a financial crisis. I mean, definitely it's a financial crisis, but that was spot out by a health crisis. But definitely, if you look at what the governments are doing, everybody is trying to chip in as much as possible to keep things afloat. So definitely, we'll try to look at how things pan out from these measures as well. Okay, so at the end of the day, just remind yourself of these 4 points. Stay calm and stay invested. Refrain from panic selling. All right, and of course, hold on to some dry powder as well, some cash, because you might never know when you need some liquidity going forward to deploy in further opportunities. All right, the third point is to also do it in a very strategic manner. Speak with your advisors how you can, strategically time your own investments or position them on a regular basis. And of course, last but not least, you need to diversify, and you need to do it globally as well. All right, so this is my last slide for today. If you have any questions, I guess you can type them in the Q&A platform, and then my hosts will read them out, and we will target and answer them directly. So I'm going to stop sharing my screen right now.
All right, thank you, Dylan, for the very insightful speech. So now we will be having the question and answer session, and afterwards we will wrap up the webinar with Randy's presentation. Due to some limitations with Zoom, we'll be going about the Q&A session via this method. If you have any questions, simply send me the question via the Zoom group chat. As you can see, I've already sent out a message in the group chat asking for questions. And I have already received some questions from several people. All right, let me just see. The first one by Alistair. Sorry if I pronounced your name wrongly. In your opinion, in the next 2 to 3 years, which industries do you think will recover the fastest, considering the current landscape? Dylan, do you want to take this?
Yeah, so in terms of sectorial wise, generally, in a sense, you can see that no sector has been spared since March. But if you were to kind of put your heads towards the future and how things are starting to recover, definitely, we'll start to see your more robust sectors like your technological space and your digital economy space companies to start getting out ahead first, right? Because those sectors have actually even continued to thrive during the crisis, during the lockdown situation. So definitely get your hands onto digital economy, ETFs, technological funds that invest in tech companies. All right. And of course, I would say that maybe even the healthcare sector has stood up a little well as well during this time. And of course, that's largely pulled up by all the major pharmaceuticals and biotechs that have been heavily invested in developing a potential vaccine for the COVID-19 virus. But that said, sectors are also becoming blurred because, when you think about a consumer staple company, it's no longer limited to a food company per se, or even a utility company. Because if you think about how we are using Wi-Fi so intrinsically in our lives right now, if you run out of Wi-Fi in a matter of 30 seconds, you can't exactly function for the next day. So, technological companies are also becoming to phase into that consumer staple space. And, the message of the day is to really get your hands or get your portfolios tilted to all these quality sectors that might come out ahead better than all the other, for example, discretionary companies like your entertainment sectors that may or may not come out that quickly. So I would say these are the sectors that you can start looking at first. Yeah.
All right. Next one. This one's by Aaron Tan. With US threatening to impose sanctions on Huawei and cause retaliation by China, what could be the direct impact of this event on the Chinese market? Interesting question. Dylan, it's all you.
Right. So definitely, I think it's still quite early to see what the real measures implemented by the US is going to be. But definitely, I would say the priority of all nations around the world is not so much igniting another trade war, right? I mean, we are already in a way so dampened down by this whole health crisis, and the last thing we want is another US-China trade war. So I would say the real priority for even President Donald Trump wouldn't be exactly to instigate another trade war, which would take a toll on stock markets. Because if he does want to get re-elected at the end of this year, then definitely he will have to do something which is in a way beneficial to not just the American people but also for markets in general. So right now, we can't exactly put a finger on the kind of things that they want to do, but we'll definitely keep you updated on the kind of policies that are going to come out ahead as well. Yep.
All right, next one. This one's by Wei Wen. So the question is, when a crisis like the current pandemic we are facing has significant financial impact, how can companies adapt their business models to reduce costs in both the short and medium term?
All right, so it's not just a matter of just being in this pandemic when companies start to realign their own principles, right? Because we've already been making calls on the quality sector even before this crisis hit. So when we talk about quality, what is quality? We're talking about profitable margins, low cash flow variability, high dividend yields in that sense, and of course a projection for growth. So all these are the kind of factors that we look out for when we invest into the underlying companies. And definitely there are some active managers or even passive ETFs that track these companies as well. So speak to your advisors on how you can get your hands on these companies, which is what's going to tide you through this crisis. But definitely you also have to look at what the current companies are doing to adapt to the situation. So for example, I think Twitter or Google, they are allowing their employees to work from home for the rest of this year or all through to 2021. All right, and then how online companies can get it also spells a kind of projection on their potential earnings ahead. So I would say definitely for the brick and mortar traditional companies that need physical contact, those would definitely have a little bit of a more of a challenge in adapting to the current space where human movement is very much limited right now. But definitely there's also some winners like even Disney, right? Although it has taken a little bit of a hit, but if you think about how it's going to continue recovering towards the through to the end of the year or even the following years ahead, I think the business model still stands, and therefore it is potentially one of the good companies that you can continue to keep your eye on. Yeah.
All right, I think we're running out of time. So last question here from Calvin Soon. Stock markets are moving forward for 3 to 6 months. Many countries, I assume, has recovered 30% since March. Is it still a good time to enter, or should we wait and see? What's your opinion? Is it a V, U, or W shape? I'm going to assume that this is a market entry question. So, Dylan?
All right, so there are many ways and many views on how one can look at this, right? So some might say it's a V shape, some might say it's a U shape, some might say it's a J shape, or some might even say it's an L shape where we don't even see any recovery for the foreseeable future. All right, there are many views on this, but my own personal opinion is that, it also first depends on what your time horizon is. If you are thinking that, you are only investing for the first year and like this year, and you are not, focusing on, potential earnings for the next 5 to 6 years or even 10 years, then, it's a little bit more difficult to make a real meaningful investment decision. All right. And another concern that a lot of investors or clients will have is, when should I really go in? Is this the right time? Then my counter question to you is, what is exactly a right time? Because if your definition of right time means to catch the exact bottom, then I'm sorry, no one can actually do that. Not even myself or Warren Buffett, because no one has a crystal ball. But what we can do is to actually, do it on a regular basis, such that, even if you don't catch the exact bottom, even if you don't, catch that lowest point, right? If you invest in, let's say right now, when when we are somewhere around, a 20% drawdown or a 15% drawdown from, December 2019 levels at more attractively valued levels, if you invest at these levels right now, then let's say, 1 year's time, 2 years time, when things start to recover, at least you would have caught around the bottom rather than the exact point of the bottom, or not being invested at all. So, I would say try not to get too fixated on that single low point, such that, you don't get invested at all and you miss a potential rally. But also speak to your advisors on how you can strategize the, the amounts going in. If let's say I were to adopt a regular savings plan strategy where I, dedicate, let's say about $500, a simple nominal amount, to my portfolio every month, right? So whether markets go up or down, my $500 is the max that I would allocate into my investment portfolio, right? So if markets go up, I'll just simply buy less units, and when markets go down, I'll buy more units. But the underlying, assumption, the central point is this, that, in the following year, if a virus vaccine does get developed, and as we are already seeing some positive encouraging signs of economies slowly reopening, then I would say, the regular savings point strategy would pay off, right? So we're definitely not seeing a downtrend of stock markets for the next 100 years as compared to what we saw in the last 100 years, right? If I were to quote Warren Buffett himself, the US economy actually saw 2 world wars, several pandemics, and even a great financial crisis in the first, in the last 100 years. But the Dow, increased from 67 to what it is right now. So, I would definitely, put my faith in the betterment of humanity, that things will start recovering sooner. But, even if it's a slow process, but it will happen slowly but surely. Yeah.
All right. Thank you, Dylan. Unfortunately, we are out of time for questions, and there are many interesting questions here. Apologies to those who could not get their questions answered. I will be sharing a post-webinar survey in the chat. So if you have any burning queries for Randy or Dylan, you can put in the survey or reach out to them directly after the webinar. So next, we will have Randy doing his presentation on PIAS and investment strategy. Over to you, Randy.
All right, thank you very much, Victor. Hi, this is Randy here. Allow me to do a sharing of my slides first. All right, okay. PIAS is actually short for Professional Investment Advisory Services. All right, so I'll be sharing a little bit more about who we are and what we do. All right. Okay, PIAS is incorporated in Singapore since 2001. And we are actually licensed under MES as a financial advisory firm. Back in 2012, Aviva acquired significant shareholdings in PIAS, approximately 81%, and thus we are now a subsidiary under Aviva. And as of today, we have more than 800 advisors, and our assets under advice is above 900 million Singapore dollars. All right, so here are some of the awards that we have been achieving for the past couple of years. Okay. As a financial advisory firm, we actually cater two segments of the market. Of course, firstly, we are talking about our individuals and families, where we do financial advisory using insurance products, using investment products, and we get towards retirement planning, children's tertiary education planning, risk management, and even estate planning, such as your wills and trusts. That's what we help our clientele do. On the other end, we also have a group of corporate and business owners clientele, whereby we actually help them to manage their business cash, their reserve management, doing some on business succession planning, and of course, core service that we do for corporate and business owners are employees benefit scheme and Keyman insurance planning. Okay. Okay, so here are some of our service providers that we work all together as a partner. So for banks, we have DBS Bank, Standard Chartered Bank, and Rockways International Group is one of our key service providers for trust and wills creation. Now, on top of that, as a financial advisory, we also look into general insurance, and these are our list of general insurance companies that we work with to provide our services. For life insurance, we do have another group of insurers that we work closely with, and of course, Aviva being our owner, we do promote their products together with China Life, Ethica, Manulife, NTUC Income, Raffles Health Insurance, Tokyo Marine, and Transamerica Life. On the fund end, on the investment side of things, we have a couple of other partners that we work with, and of course, we have IFAST Financial, which is where Dylan is coming in today. So some of the fund houses that we do carry include all that's listed here. If there is any fund that is not within this list that we do not carry, typically we will get our clients to share that with us, and we can speak with our providers like IFAST to see how we can onboard the fund into the platform. So over here at PIAS, what we do is that when it comes to investment, we have a very disciplined investment strategy. So it consists of both qualitative analysis, and also we stick to outperform the sector averages. What we do is that we make use of our own high conviction list, which does a short list of the best-in-class funds spanning across the entire various segments of the different asset classes, different sectors, and of course having different geographical focus. So with this, we have a thing what we call model portfolios. So model portfolios are created for investors who are not as savvy, but they would like to have a certain level of returns, and they want to have their portfolio tied towards their personal goals and objectives, right? So what we have here is with model portfolios, we will manage our investments that ties in together with our financial goals. Over here, we have an example of a balanced cash portfolio. So funds will be specifically selected to cater to a portfolio of such a segregation. Say we have a portfolio of balanced cash where we have 45% in global bond, 20% in aggressive mandate, 15% in global equity, and 20% in balanced mandate. For a portfolio like this, we are assured that returns will be more on the positive end, but on the lesser risk base, because we have almost half of our funds in global bonds, which is a little bit on the risk adverse side. So this encourages us, encourages our clientele who are more on the balanced investment kind of risk level to still participate in having a positive return, and yet securing as much of their capital as possible. So of course, other than balanced cash portfolio, we also have an aggressive cash portfolio, whereby more funds are being selected for a higher return. But as Lee mentioned, being in the aggressive portfolio, there's also a high significant amount of risk involved. So when it comes to managing of investment goals, we look into a couple of sectors that include things like taking into consideration risk management side, having a good diversification of different types of funds and the different sectors. And also with a portfolio, you are not that as emotional as compared to maybe investing directly in a share, because with a portfolio, we are more looking towards a medium term to a long term run, whereby you really go in and wait out for the sector to come up. And for those high yield bonds, right, they actually give out dividends, and that is also one of the returns that we are looking at. And when it comes to the portfolio monitoring side, we have our own in-house team of analysts, and they'll be helping us to study into all the various funds. As you can see earlier, there's really thousands and thousands of funds that's available in the market, but you could be asking yourself like which one whether to buy. So not to worry, that it's been taken care of by our in-house analysts and with the help from our partners like IFAST. Right. And lastly, when it comes to the fund selection, you'll be make known to you which are the funds that is being selected for each portfolio. So you can actually know exactly where your money is going into. Right. So in summary, I'd like to share that in PIAS, the clients are our core focus. What we do here is really to ensure that all our customers are well taken care of, and we want to ensure that whatever that is being introduced is well within your own risk portfolio, and we do not do anything that is beyond what you can manage. Our end goal is to realize your end goal, right? Okay, so with this, thank you very much for attending the webinar today, but don't leave first. If not, because we have a feedback for the webinar today, and if you will kindly go on to this link here, survey for webinar, or you can use your phone camera to capture the QR code, leave behind your details and give us some feedback. What I'll do is that for all of you who have given the feedback and you indicated a yes for sharing of slides, I'll be sending out an email to you together with the slides that we'll be sharing today. All right, thank you. Back to you, Victor.
All right. Thanks, Randy, and thanks, Dylan, for the presentations. So we have now come to the end of the webinar. If you have any further questions or feedback, as Randy has mentioned, please fill out the form via the link I've sent in the chat, or you can scan the QR code. If you are interested in receiving both sets of slides used for this seminar, again, just make a request via the survey form. Thank you for taking the time to attend this webinar, and I wish all of you a great week ahead. I'll be sending the link to the survey again in case anyone has missed it. And we'll actually have this video on for a while before we shut it off at maybe say 3:17. Yeah, thanks for attending. Thank you, everyone. It's been a pleasure.